The best trades don't start at the breakout. They start in places most traders never look, hidden zones where smart money enters quietly. These entry points come in different forms, but there's one pattern that shows up again and again before big moves, and most retail traders completely miss it. Once you know how to spot it, you'll understand exactly where the real move begins. It's called the compression candle, and it's not what you think. In this video, I'm going to show you what the compression candle really is, how it works inside the market maker circle, and how to trade it using real chart examples across multiple timeframes. You'll also learn the different compression setups, including the powerful compression fakie, so you can enter with smart money, not against it. Before we dive in, tap that like button, subscribe to the channel, and hit the notification bell so you never miss a smart money strategy that could change the way you trade. A compression candle is a candlestick that forms entirely within the range of the previous candle. That means its high is lower and its low is higher than the candle before it. It's literally getting squeezed, like pressure building inside a box. This pattern may look simple, but it tells a powerful story. It signals a moment of indecision in the market, a pause in momentum, and more importantly, a buildup of pressure. But here's the key: a compression candle is not just a random pause. It's a setup candle, one that appears right before the market makes a decisive move. Smart money loves to use this pattern because it gives them the perfect moment to build positions quietly while retail traders are distracted or uncertain. When you spot a compression candle in the right context, you're potentially looking at a launch pad for the next big move. Now, before you skip ahead, listen carefully because this is where most traders get it completely wrong. You might be thinking, isn't this just an inside bar setup with a fancy new name? No, it's not. And if you treat it like one, you'll miss the entire move. Let me show you why. A normal inside bar is just a pause, a moment of indecision. It sits inside the range of the previous candle and appears all over your chart. Most traders try to trade every inside bar they see, and they get chopped up by false breakouts, but a compression candle is different. It's a strategic candle formation that only forms after a liquidity sweep. That's when the market grabs stop losses above or below a key level. And here's the key: as price starts its displacement move, when smart money pushes price away from the trap, the compression candle forms, revealing a hidden entry zone. This is where smart money enters, not before, not after, right there. That's why you don't trade all inside bars. You wait for the compression because it shows you when the market maker is in control. So don't rush, because in this video, I'll explain everything you need to know so you can start trading like a market maker, not like a confused retail trader. Before we dive into how to use the compression candle, there's one thing you absolutely need to understand. It's called market structure, and there are only 3 types that the market moves in. No matter what asset you trade, the market is always in one of these phases. If you try to use the compression candle without knowing which phase you're in, you'll either get trapped or stopped out. So let's break it down. The first structure is the uptrend. In an uptrend, the market forms higher highs and higher lows. It moves in waves, first with an impulsive move upward, then a retracement downward. The impulse is where smart money drives price aggressively. The retracement is where they look to reload, buying again before the next leg up. This structure tells you the market is bullish, and your job is simple: look to trade in the direction of the trend. The second structure is the downtrend. Here, the market forms lower highs and lower lows. It also moves in waves, a strong impulsive move down, followed by a short retracement up. Just like in the uptrend, smart money is in control, but this time they're selling into the rallies. This tells you the market is bearish, and your edge comes from aligning with that momentum, not trying to fight it. The third structure is the range, also known as a box market. In a range, price moves sideways, bouncing between horizontal support and resistance. There's no clear direction here. The market is in balance, with buyers and sellers testing both sides of the box. But this is where smart money often lays traps. They lure traders into thinking a breakout is coming, only to reverse it. So you have to be very careful when trading ranges. And that's where the compression candle becomes extremely powerful, especially near the edges of the box. Now that you understand market structure, let's apply the compression candle. Look at this chart. We're clearly in a downtrend. The market forms a lower high, followed by a lower low, then another lower high, and another lower low. Classic bearish structure. Then the market pauses and starts to range, moving sideways with no clear direction. Eventually it breaks below the range, and right after that, a compression candle forms. It looks like the perfect setup. The downtrend is intact, momentum is back, and price just gave you a clean breakout. So what do? You wait for the compression candle to break, and when it does, you enter the trade. The market breaks below, confirming the setup. You place your stop loss just above the mother candle and aim for a solid risk to reward. Everything looks perfect, but look at what happened next. The market reverses. It shoots up aggressively in the opposite direction. You're stopped out within minutes. So what went wrong? Here's the truth. That wasn't a real compression candle. It was just a basic inside bar, nothing more. And if you don't know the difference, you'll keep falling for the same trap. That's why most retail traders lose money, because they trade these patterns without understanding context. So if you want to know the real difference between a standard inside bar and a true compression candle used by smart money, stay with me. Because in the next section, I'll show you how to identify a real compression candle, how to confirm it with liquidity and displacement, and how to trade it like a market maker, not like a retail trader walking into a trap. Alright, now to trade the compression candle correctly, you need to understand the 5 phases of the market maker circle. Let's go through them one by one. Create liquidity zones, trigger a liquidity sweep, launch the displacement move, create hidden entry zones, and extend the displacement move. We'll go through these phases one by one so you can understand exactly where to spot the right compression candle and how to make the best possible entry alongside smart money. Let's start with the first phase, creating liquidity zones. As you can see here, the market is building a buy-side liquidity zone. This is where stop losses from retail traders begin to pile up, right above recent highs. And this marks the first phase of the market maker circle. The second thing market makers do is hunt liquidity. They push price just above a recent high or just below a recent low. Why? Because that's where most retail traders hide their stop losses. This move triggers breakout buyers and squeezes out early sellers, providing the fuel smart money needs for the real move. But it's not the real move yet. It's a trap, a liquidity sweep. After collecting liquidity, smart money shifts gears. Now they create a displacement move, a strong, aggressive push in one direction. This move breaks structure, forms fair value gaps, and leaves behind liquidity voids. Classic signs of institutional intent. You'll see large candles, little hesitation, and a clear change in order flow. But here's where most traders miss the entry. During the displacement, right in the middle of that powerful move, the market doesn't always move in a straight line. There's often a brief pause, a moment of compression inside momentum. This is what I call the hidden entry zone. It's not a pullback, it's not a reversal, it's a tiny, controlled pause inside the impulse, engineered by smart money. And inside this pause, they often leave you a signal, the compression candle. It's your chance to join the displacement while it's still unfolding. This is how smart traders catch the move early, with tight risk and without chasing price. Let me show you a chart example. As you can see here, the market moves down, hits a level, and reverses, creating a support level. This level is where stop losses from buyers are sitting, also known as sell-side liquidity. And this marks the first phase of the market maker circle, creating liquidity zones. Now look what happens next. The market breaks below the support level, sweeps the liquidity, and then closes back above it. That's the second phase of the market maker circle, the liquidity sweep. Retail traders are trapped, and smart money is now in control. As we said earlier, after the liquidity sweep, the market makes a displacement move. This is the money move, the real shift in direction driven by smart money. Here's how you can confirm it. The first candle after the sweep is usually strong. The second strong candle confirms the displacement. During this move, you'll usually notice at least one of 3 key signs: a clear momentum shift, a market structure break, or the formation of a fair value gap or liquidity void. And in this example, we clearly see a fair value gap forming. Now we move to the fourth phase of the market maker circle, the hidden entry zone. Here's what most traders miss. During the displacement, price doesn't just move in a straight line. It often pauses briefly, not long enough for a full pullback, but just enough for a tight consolidation. That small pause is the hidden entry zone. It can take different forms, but what we care about here is the compression candle. So what is it? A small-bodied candle that sits within the range of the previous candle and often forms right before the next strong push in the direction of the displacement. This is not just another inside bar, this is a compression candle, because it forms after a liquidity sweep and during the displacement move. It's a hidden pause created by smart money just before the next wave, and that pause, that's our opportunity to enter with precision, not hope. Now, How to trade it. Once the compression candle forms inside the hidden entry zone, you take action. Wait for the breakout of the compression candle. You might be asking, why the breakout? Because the breakout signals the end of the pause and the continuation of the displacement move. Here's how to enter. Place a buy order at the close of the candle that breaks above the compression candle. Stop loss, just below the low of the mother candle. Target, the next level, aiming for at least a 2-to-1 reward to risk ratio. Now, look at what happens next. The market breaks the high of the compression candle. Momentum continues, and the setup plays out with precision. You didn't chase the move, you didn't guess the trade, you followed the market maker circle step by step. To trade the compression candle with precision, you need to use two time frames, the higher time frame and the lower time frame. We start with the 1-hour chart. This is where we identify the key phases of the market maker model. First, the market creates a liquidity zone. Then it sweeps that liquidity with a false move. And finally, it begins the displacement, the real move, confirmed by just two strong candles. Once you've confirmed these three phases on the 1-hour chart, you switch to the 5-minute chart. This is where the hidden entry zone comes into play. On the 5-minute chart, you'll look for the compression candle forming during the displacement. Once it's there, you execute the trade. Right on the 5-minute time frame, with full confidence, you're aligned with smart money. Now, before we move on to more advanced concepts in the strategy, you need to understand that compression candles don't all look the same. There are two main types. The first is the traditional single candle compression. It's a small-bodied candle that forms entirely inside the previous candle's range. It's tight, clean, and controlled. This shows a quick pause in momentum, a moment where smart money is quietly reloading before pushing again. The second type is more subtle. It's called multi-candle compression. Instead of one small candle, you'll see 2, 3, or even 4 candles, all forming within the range of one large displacement candle. It's still compression, but stretched over time. Think of it like this. The market is taking a deep breath before continuing the move. Smart money is building more position, but doing it silently. Whether it's a single candle or a cluster, both types of compression can give you powerful entry signals, as long as they appear at the right place in the market maker cycle and during the displacement move. That's how you stay in sync with smart money. Now, the example I just showed you was on a single time frame, and while it worked beautifully, that's not the complete picture. Now let me show you a real chart example where we apply the exact rules we just talked about. This is the British pound US dollar on the 1-hour chart. As you can see, the market was trending down. Then it hits this level and reverses, creating a clear support level, and that becomes our sell-side liquidity zone. After the market retraces, it sweeps that liquidity and immediately pushes higher. That move confirms a liquidity sweep. Next, the market approaches the resistance level and breaks through it with strength. That's your displacement move. At this point, you've identified all the key phases of the market maker circle: the creation of the liquidity zone, the liquidity sweep, and the displacement move. And remember, just two strong candles are enough to confirm that displacement. Now that we've confirmed the setup on the hourly chart, we switch to the 5-minute chart to wait for the compression candle. On the 5-minute chart, you can see part of that displacement move we spotted on the hourly. To join the move, we need to wait for a compression candle to form, and here it is. This small-bodied candle appears within the range of the previous one, right in the middle of the move. That's our hidden pause, and our signal to enter. Once the breakout happens, we take action. Place your entry at the close of the candle that breaks above the compression candle. Set your stop loss just below the hourly resistance level, which is now acting as support. Target the next logical level, always aiming for at least a 2-to-1 reward to risk ratio. And now, look at what happened next. The market broke out, continued higher, and hit our target perfectly. This isn't guesswork. We entered because we understood that a displacement move had started, and the compression candle gave us a precise entry point to join smart money at the right time. Now, we've already studied the traditional compression candle, which is a mother bar followed by an inside bar. Sometimes there are multiple inside bars within the range of the mother bar. It's called a compression candle because it appears after a liquidity sweep and a displacement move. But now let's talk about the second type, and it's a very powerful one. This one is called the compression fakie setup. It includes a mother bar and one or more inside bars, followed by a fakie candle that creates a liquidity sweep before the market moves up or down. It's an advanced setup, but once you recognize it, you'll see how powerful it is for catching high probability trades, right at the point where smart money enters again. There are two types of the compression fakie setup, one for bullish moves and one for bearish moves. Let's start with the bullish compression fakie setup. It begins with a mother bar, followed by one or more inside bars. That's your compression. Then, a candle breaks below the mother bar, sweeping liquidity, but it closes back inside the range of the mother bar. This false break creates a classic bullish trap and signals smart money is preparing to drive price higher. Now, let's look at the bearish compression fakie setup. Just like before, it starts with a mother bar and one or more inside bars. Then, a candle breaks above the mother bar, sweeping buy-side liquidity, but it closes back inside the range. This is a false breakout to the upside, and it often marks the beginning of a sharp bearish move. In both cases, the compression builds pressure, the fakie sweep clears out retail traders, and smart money takes control for the next leg of the displacement move. Let me show you a real chart example on the US dollar Japanese yen on the hourly chart. As you can see here, the market hits a level and reverses, forming a support zone. This area acts as a liquidity zone, also known as sell-side liquidity. The market then pulls back, breaks below this liquidity zone, and quickly closes strongly above it, confirming it as a clear liquidity sweep. What follows is a strong upward move. This is what we call a displacement. Now, we switch to the 5-minute chart. On the 5-minute time frame, we can spot a compression fakie setup. This setup shows a double liquidity sweep, signaling that smart money is preparing for another move up. So on the hourly chart, we've identified the market maker circle model. And on the 5-minute chart, we have the compression fakie setup giving us confirmation. At this point, we wait for a break above the mother bar to confirm the entry. Once the breakout occurs, we place our entry above the breakout, set the stop loss below the strong rejection candle, and target the next key level. Now look at what happens next. As you can see, the market pushes directly to our target. This was just a chart example to show you how to spot and trade the compression fakie setup with proper structure and multi-time frame confluence. Now you know how smart money creates hidden entry zones and how the compression candle reveals the moment they quietly step into the market. If this helps shift the way you see price action, make sure to like, subscribe, and turn on the bell so you never miss a strategy like this. Thank you for watching and see you in the next video.